And welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, 17th of March, and I'm back from my skiing holiday last week. It was a 4-day break. It was absolutely fantastic. And you had to do the podcast with David Scriven, didn't you, Phil?
Yes, I did, Andrew.
But you missed me, though. You missed my merry tones.
Oh, I have to say, yes, I did.
Yeah. Anyway, look, it's we've got an incredibly busy day today, but we wanted to get this podcast done. So it could be quite a short one. So that'll probably be a relief to all the listeners. Less rubbish coming out of us. So let's get cracking anyway. Phil, why don't you start it off? Tell me what you want to talk about.
Well, worked, Andrew. You nicely put me on the spot. I'll tell you what, and something that we discussed between us, because we've generally been talking about the energy transition and battery technology, was Gelion, tickers GELN, battery tech company, 109 million market cap. We had interims results, but we were pretty interested in what they were having to say about the what's happening in the battery markets themselves.
And they had a good bit, didn't they, on LDES, which is long duration energy storage. It was a really good piece in their results that they wrote up.
Yeah. I'm talking about the rising prices for lithium, and particularly the rising energy costs in Europe, and probably the drive for greater renewables. So some pretty interesting themes, and that we've been discussing too. So pick that up. Did you see?
Well, before you move on that, it's interesting. Yeah. I mean, lithium prices actually have gone up again to $75,000 a ton, and we are now seeing all over the shop people sort of saying, look, long duration energy storage is the way forward. We've got to find solutions to it, and that lithium, not only because it blows up and bursts into flames, but we can't use lithium. It's just becoming too damn expensive. Now, we know that there are going to be different solutions to long duration energy storage, but we are starting to see all sorts of deals. I see the other day that an Australian group, they're an integrated vanadium miner and vanadium flow battery company, got a $49 million grant from the Australian government to fund the development of vanadium flow batteries.
Wow. So it's amazing how the environment is changing so quickly.
Yeah. I mean, I think the trouble is there's still a huge question mark over this whole LDES. What's going to be the win? What isn't? I noticed today, actually, I'm really disappointed that Pivot Power, who, as you know, are part of EDF now, and obviously are in charge of the Energy Super Hub Oxford, which is where Infinity Energy Systems have got their big vanadium flow batteries. They just announced 2 more super hubs, one in Cornwall as well. Everybody knows I love Cornwall. And they appear to be all lithium, which just doesn't make sense. I'm confused by that one. I need to do some more research into it.
Mm-hmm. Yeah, well, the other one's in Luton. Yes, I saw that.
That's right. Yeah, Luton.
Yeah, indeed. Yeah.
So it's all happening in the space. Largo Resources also, they announced results yesterday. They're another integrated, but they are obviously with vanadium flow batteries. They're getting their batteries out there as well. It is all sort of happening. It's really quite it's exciting, confusing, and there is a lot of confusion, I think, about what are the solutions, and we need to find some clear-cut winners as soon as possible.
We do, but we will keep our listeners abreast of what's happening in that market. That's for sure.
Yeah.
Okay, and so I was going to mention, Andrew, did you see? We talked a lot about sort of tech sector investments, and obviously, lots of things happening in the market at the moment in technologies. But I saw that IP Group had their annual results out.
I did see it because I own them personally in my pension fund.
Well,
and I bought them at about 70p. Watched them all up to 140p. When it doubled, I thought, shall I sell them? But I thought, no, I like it longer term. Watch them come all the way back down to 70p, although they're now back over the 90s. But they were bloody good results. I mean, they were fantastic results.
Well, there's an investor experience for you. So you obviously take a good long-term view on this one, Andrew. Delighted to hear that. But yeah, their annual results. I saw that their profits Yeah, I mean, they're amazing. I mean, the profits increased from 185 million to about 450 million. And what sort of caught my eye is they were seeing a strong performance across all of the sort of tech sectors. And they were able to realise cash. And of course, they had the IPO of Oxford Nanopore, which they'd held. I didn't realise this. They'd held it since 2005. And they got a 14% stake in that. So I think they realised a bit of capital on the IPO, but they're still a holder on that. So it shows the success of this type of model for investing in tech.
I mean, it's interesting because one question is, why am I invested in it? And the answer is, I wanted to have exposure to technology that maybe I don't understand well enough to do a direct investment, and also to biotechnology, which I certainly don't understand, and certainly not enough to do a single investment. IP Group, really, I mean, we talk about profits there. The profits really are almost irrelevant. It's the NAV, because they're effectively an investment trust, aren't they?
Yeah.
But I like it, and it's one of the bigger ones. It was, in my view, when I bought it, seriously undervalued because of the Woodford situation that had distorted the share price, which is why I picked IP Group, and maybe not Draper Esprit. But of course, we've got Forward Partners now as well out there. But we've also had results today, and we just actually had one reason for a bit short time in our boardroom is Neil Crabb, the CEO of Frontier IP, that we also act for. And I mean, actually, they had an enormous profit jump, but also enormous NAV jump because of Excentia, which floated on NASDAQ and has been just phenomenally successful. Now, they have a slightly different model, don't they, Phil?
Yeah, they do. And it's a really interesting one. And I don't think they always, it's always noticed with this company how they make their money. Frontier IP get involved at a very early stage in IP, intellectual property, primarily from leading universities in the UK. And they work directly with the spin-out companies from the unis with the IP, and they help them to actually build their business, to develop their technologies, very hands-on this, and to bring in large commercial partners to help commercialize their technology. Now, in doing all of that work for these spin-out companies, they actually get rewarded in equity shares in these companies, and so they end up holding stakes. So, I mean, they essentially, their shares in Exscientia, which is AI drugs discovery, it's now listed on NASDAQ, and it was originally listed, the IPO was done at a valuation of 2.9 billion. Frontier IP's shareholding in this was for free. It was for the work that it undertook. It didn't pay for its shares, and they still hold a shareholding in it today.
Yeah, look, I mean, I think we've talked again quite a lot on this podcast about some of the smaller technology groups where you can get some real leverage coming out of them. I've known Neil Crabb, the CEO, for about 35 years or so, and he's a very clever guy. So it is a really interesting situation, and it's not one you buy for a trade. It's one you buy and you tuck away for 5 years, and I think it could be. I think since they've been listed, they're up about tenfold, and I think it's pretty obvious that Neil intends to make them go up another tenfold. So as long as you've got a bit of patience, great stock to be in.
Yep, very exciting story. Yep.
We've had quite a lot of news out, haven't we, this week on the fuel cell market, because we've had news from AFC, we've had news from ITM, we've had news from Ceres as well.
We have indeed, and you've probably seen a bit more of that than I have, actually.
That's because I keep my. I'll give you a bit of a clue. I mean, I think on Monday AFC announced that they had, in collaboration with Keltbray,
that's right. Yeah.
Their first fuel cell lease they did into the UK. Leasing is quite interesting, actually. I mean, I think most people know that I don't have the most positive view on AFC, but it's all about valuation. But leasing is very interesting at the moment, I think, because we all know that with new technology, some people get nervous about buying something they've got to keep for 25 years or something, Whereas if you lease, well, if it doesn't quite work, you can hand it back. There's less risk to the person who takes it on. But of course, if the product's great, then if you lease, you can actually make more money. I mean, for instance, if you leased at the moment a battery, because of the way the UK market power system is working, I mean, the fluctuations are so enormous that actually by leasing batteries, you could make more than by selling. But as I say, it actually makes it easier for the customer to take on. So it's actually a very interesting concept. that actually did catch my eye. We also then had ICM, who came in with some news. Unfortunately, they've had a delay. But I mean, again, I don't think that one needs to worry too much about that. In as much as we know that these things take quite a long time and delays come along, and in the current environment with a pandemic and a war in Ukraine, which is just terrible, clearly delays are going to happen, aren't they? So, but yeah, they did have a little delay, didn't they?
Yeah, I think particularly with engineering companies at the moment, anything that's using sort of electronics components and needs boots on the ground or whatever to install equipment, then we're going to get delays, and you've just got to kind of be very, very patient at present and see through that, because inevitably companies like this have lots of professional folks involved, and in time, things will recover.
Yeah. So it's fine. We're not going to knock them for that one. And then, of course, today actually we had Ceres Power, where I mean, it's again, they've got such a good corporate structure, and they've got so much cash because all these corporate partners, Bosch and Wanchai, have just supported them. I think they come and announced they got 250 million of cash or something. Their revenues were up 44% to about 31.7. It's all looking pretty good. But again, going back to some of the sort of stuff we said, I might just read a bit out because I think there's one or two bits actually worth reading from their statement, which is that they actually say estimates suggest, well, first of all, it's on the hydrogen market. Estimates suggest that hydrogen could eventually account for 18% of primary energy, which is $2.5 trillion. But interesting enough, they also said our first investment announced in November in long duration energy storage, LDS again, with RFC Power. So that actually, again, they're looking at putting, which what we've talked about all the time, putting fuel cells together with LDES. And that is sort of the way it needs to go, because if you're running a fuel cell to create hydrogen, green hydrogen, you've got to run it off your solar panels or your wind, and of course they don't always function, so you've got to have this LDS sitting in the middle. And actually the fuel cell companies should be talking to the LDS companies, and that's interesting that they are.
It is. It's quite. I thought that was quite a strategic move for Ceres, and they're very well funded, of course, to exploit that. I'm keen to see how that develops.
And I think you probably will.
I hope so.
Now, actually, also, I think I don't know if you saw, but on a similar sort of vein, hydrogen, was it Hydrogen One or? You've looked at that, have you?
No, but there was an announcement out from them. I'm sure was it Hydrogen One?
Yeah, it was Hydrogen One, wasn't it?
Yeah.
And I'm going to read it out to you in a second. I've just got to quickly find the right sort of page. So Hydrogen One, they what was interesting about them in their announcement, they were just more updating about the market in general. Yeah. But they put in this paragraph, changing market environment. And they basically said the Russian invasion of Ukraine has shown governments around the world, and especially in Europe, the vital importance of sustained investment and policy support for domestic energy production, and crucially, diversity in energy imports from overseas. And so they go on about that and how hydrogen can play this vital role. And they then actually go on basically to say again what we're saying, which is that hydrogen, fuel cells, LDES, SWB, whatever you want it, they're all interconnected. Now, we've been saying this for years and ever since we started this podcast, but the market hasn't quite, I don't think, grasped that yet. There is a big connection between LDES and fuel cells, solar and wind, and the big clever players are working it out. But just bear that in mind when you're making your investments, okay?
Yeah. That's an interesting fact. And if you look at Siemens' website, Gamesa, I mean, Siemens do sort of go into this quite a lot in terms of how the products sit in the energy infrastructure. But you're right about sort of the general investment market kind of grasping how things are moving now, and it is moving in a different way. Interesting.
Yeah, it's interesting you mentioned Siemens, but I mean, obviously we talk quite a lot about Siemens. It's a European company, had a lot of profit warnings. It's owned by a lot of UK institutions. I know that. And obviously, they have a joint development with Infinity. But I'll tell you, you want to look at what people like. I don't think you've been seeing what GE have been doing recently. They're disposing of certain things and breaking their business up into very specific companies. One of which is renewable energy. And GE want to be right in this space. And I would say if I had to have a bet between GE being successful and Siemens Gamesa being successful at the moment, because Siemens Gamesa seems to be in chaos, I'd go for GE.
Yeah. No, they are. Yeah, they are. And but yeah, as you say, boy oh boy, watch them move, and I'm sure they'll move quickly. Yeah.
Anyway, that's probably enough on transitional energy. We are rapidly going through this, guys, so I apologise about that. But I noticed a few other things. I'll just whiz through some that I saw. I saw that Alpha Wave IP did quite an interesting potential acquisition. Well, they've announced a potential acquisition for $210 million of cash of Open 5.
Yeah, that's risk 5. Yeah, risk 5 technology, wasn't it? Yeah.
Yeah. I thought that was quite interesting. And talking of acquisitions, I see it's only a small one, but I see that Traxys has acquired Railcom, which is a North American-based rail technology software company. It was very small, but I think Traxys is starting to do a lot of very interesting things. Their software does often sit around the railway.
Yeah, it does. Yeah. The rails, and they do a lot of sort of planning on transport in terms of timetabling and stuff, and timetabling management. Yeah, they do a lot in the transport sector, Traxys.
Yeah, so I think Traxys probably gets our vote.
Yeah.
What have you seen anything you want to slip in?
Well, we have, as we discussed before, Computer Center, Andrew.
Yeah, I saw that.
Yeah, full-year results. 3.2. There's a bigger one, 3.2 billion market cap. And this is just quickly the rating on this. It's on 0.5 times sales multiple and 12.6 times EV/EBITDA, and pays a div. So it's not overly priced, but it's IT services. So you don't necessarily get the rating, but nonetheless, this is such a consistently performing business. They provide IT solutions, security, data center, networking technologies, all those sorts of things that you're in office, you're using in tech. Full year results, and they said that their revenues grew by 23.6% in the year, which was very, very good. And of course, we've seen a lot of shifting spend around, COVID and IT spend recovering, but nonetheless, that was a strong performance by them.
And they were pretty upbeat, weren't they, about so that they can carry on at that pace as well.
Yeah, absolutely. So
talking about being upbeat, it's a company that actually rather interests me. I'd like to meet them. Did you look at MPAC? They had full year results today.
No, I missed that one, Andrew. Go on.
Yeah, well, the reason I'm interested in that one actually is because they've started building batteries for people. So they don't actually design them at all. Yeah, but they signed this deal with, I'm going to pronounce it wrong, but Freyr, Freyr batteries. It's a Nordic company anyway. But basically, they develop clean next generation battery cells, whatever. They're lithium ion ones actually, but MPAC actually manufacture them and clean manufacture them cheaply. And but these were really good figures actually, and the stock's gone up nicely today. But it's interesting to see battery manufacturing taking place in the UK actually, because we always think of it as got to be done in some sort of low-cost country like China. People are moving away from that concept. I think nice to see that it's happening in the UK. So well done, MPAC.
Super. I'll take a closer look at that. That sounds very.
Quite an interesting company.
Yeah, that's superb. All right. I don't anything else that you've got, Andrew?
It's maybe worth mentioning because we do occasionally that Aquis. Obviously, we are now the corporate advisor to them on the Aquis exchange as they're dual listed. They've also announced that the VSA Capital, that's us, will be running the Aquis Apex Index, and they're just doing one or two little bits of pieces, adding on to their group. They seem to be getting, having I'd say they lost a little bit of momentum because of some of the issues. Just it's not easy building an exchange and a trading platform. Seem to be getting a bit of momentum back again. So I'm sort of rather hopeful for that in the next 3 to 6 months. We could see a good run out of that stock. It slipped all the way back down from £7. It slipped down to about 4.40 or something. It's now 4.80, 4.90. And I feel, I think it's getting a bit of momentum back into itself.
All right. And I think they've got results coming up in due course as well, Andrew. So we'll cover those at the time.
Yeah, actually, in another one, talking of results, I don't know if you looked at the Deliveroo results today. I mean, Deliveroo has just been a disaster since IPO. Why people take these big IPOs from the big banks, I do not know. You look at Deliveroo, Doc Martens, all these things. Everybody's lost such a lot of money. They say that they still. Well, they said they still see a pathway to break even and long-term profitability. Yeah, well, they may see that, but I saw a loss of nearly £300 million. Don't buy stock losing that much money. You're going to be waiting decades before you make any money. There you go. That was a little bit of a rant from me, wasn't it?
Yes. And on that note, so they're clearly, yes.
All right. Should we make it our shortest podcast ever?
Go on then.
Okay. We'll make this the shortest podcast ever. There's not much been going on in the brand space, so we haven't got to worry too much about that. I hope everybody enjoyed it. I'm actually. I think we will get the podcast done next week, although I am jumping on a plane next Thursday to go to the USA to work on a major deal that I'm trying to put together. Obviously, can't say a thing about it, but we'll try and get it done before I take off so that we keep everybody up to speed. The Thursday after that, I'm actually going to be in San Francisco. So we'll either try and do a late one with me from San Francisco, or you'll be back with David again. God, didn't you just love it? On that note, very good. As usual, if anybody's got any ideas they want us to talk about, or if anybody's got any comments, do let us know. We love getting feedback.
Chat again soon, Andrew.